Daniel, I was reading your Epoch Times article on this topic. Let's just talk about who's accountable here. You talked about a number of factors. The Fed was one of them. Maybe you talk a little bit about that.
Well, if we look at the collapse of the Silicon Valley Bank, one of the key aspects that we need to take into account, and this is something that is happening with other of the banks that have been looked at as risky, is that the problem was the accumulation of risk in the period of the everything bubble created by negative real rates and by massive quantitative easing. If you think about it, it was the Silicon Valley Bank success in doubling deposits and assets and parking 50% of those assets in sovereign bonds and treasury bills and mortgage-backed securities, what created its demise. Because, yes, the investments in technology, biotech, clean energy, etc., many of those fell significantly in value, absolutely. But what really created the financial hole in the Silicon Valley Bank was the mark-to-market of its unrealized losses in the portfolio of hold-to-maturity long-term sovereign bonds, treasuries. And that in itself, a 200 basis points increase in the yields, recreated basically a massive loss for the bank that was equal to its entire market cap. So the challenges that we're seeing is that this is something that is going to be very difficult to manage, because when the risk accumulation is so widespread and it's incentivized by policy, because Silicon Valley Bank and the other entities that are currently under risk did not do anything that was out of the ordinary or that was against the regulation. What they did was exactly to follow the regulation and what the mainstream economists and the mainstream policymakers were recommending, which was to invest as much as they could in order to cushion their asset base in sovereign bonds and in mortgage-backed securities, and those have created the demise of Silicon Valley Bank. So it's going to be a very difficult one to address in the near future, because if on the one hand the Federal Reserve stops its rate hikes and goes back to a hugely accommodative policy, the big risk is that inflation runs wild, and that also creates a backlash in the valuation of bonds and equities and technology assets. Whilst if the Federal Reserve decides to continue with its policy, the challenge created in the past by the bubble of everything, as many of us called it, are going to remain. So it's going to be very difficult to eliminate the risk of at least a few banks falling because of this excess of the past.
So I guess SVB followed to the letter, I guess, the recommendations of policymakers. So maybe if the Fed wasn't behind the curve, you remember them saying that inflation was transitory. If they actually weren't behind the curve and then they tackled inflation correctly, perhaps this wouldn't have happened. What are your thoughts?
Completely. I completely agree. Think about this. Why would Silicon Valley Bank not hedge the duration risk of its hold-to-maturity sovereign bond exposure? For a very simple reason. Because they were following to a T what the Federal Reserve and mainstream economists were saying, that inflation was purely transitory, that there was absolutely no risk of persistent inflation, that it was because of the base effect, and therefore a bond held to maturity was a very good investment and a very solid and safe investment. That was the problem. So if the Federal Reserve had started hiking rates earlier and reducing its repurchase of bonds and mortgage-backed securities earlier, certainly Silicon Valley Bank and other smaller banks would have not added more and more into this risky bet against the reality of elevated inflation and the reality of stagflation risk. It's as simple and as dangerous as that, because a lot of people these days are thinking that all of the problems that have been created in the past week come from the rate hikes. But rate hikes did not create the demise of SVB and the other bank that collapsed today. No, what created the demise of these banks was the accumulation of risk in sovereign bonds and in mortgage-backed securities, because they followed to a T the recommendations and the analysis of the macroeconomic challenges of the Federal Reserve and the mainstream economists.
So what I see here is the Fed really believed inflation was transitory, and SVB really believed in the Fed. Now, then what's the lesson here? What do you take away from that?
The lesson is that more regulation is not ever going to stop problems like this, because it was regulation and it was policymakers' recommendations and comments what created this enormous accumulation of risk in assets that the banks perceived that had no risk. The only way in which a bank accumulates risk in a type of asset, sovereign bonds in this case, is if they believe that there is no risk. Think about this. When you look at the asset base of Silicon Valley Bank, what you see is that the investment in high-risk tech or crypto or renewable energy assets was very limited, actually, relative to the deposits or relative to the asset base. Where there was a massive level of accumulation was in mortgage-backed securities and treasury bonds, which obviously were something that they perceived had no risk and certainly were told had no risk. So the big lesson is never believe that regulation created by those that build the bubbles is going to sort out a problem created by those bubbles.
And Daniel, I would like you to talk a little bit about this as well. The FDIC's report says there's $620 billion of unrealized losses sitting in all the banks. Tell us a little bit, how did that happen?
Well, when you have the assets of a bank, most of the assets of a bank are loans to customers, obviously. There's part of those assets that are investments in safe assets that that would provide a cushion when there are changes in the value of the other assets. No, most of that cushion is usually parked in sovereign bonds and treasury bills. Okay, so treasury bills are usually what banks take are long-term treasury bills. What happened in 2020 to 2021 was that the price of treasury bills went through the roof because the Fed was constantly purchasing, and the yield went down, obviously. What happened in 2022 was that the bubble of valuations of sovereign bonds all over the world burst just with a few rate hikes. And as those rates are higher and inflation is higher, what investors perceive is that the yield that those long-term bonds provide is not just insufficient, but a massive loss. So the price of the bond falls, and the owners of those bonds have unrealized losses. They have unrealized it because they haven't sold them, but they have unrealized losses from the purchasing price of the sovereign bond to where it is currently trading. As inflation is higher, those very low yield bonds issued by governments, instead of being a safe asset that creates stability in a volatile market, become a volatile asset with enormous unrealized losses in a inflation driven macroeconomic environment.
So I think you talked a little bit about this when I asked you what's the lesson here. The bank's risk management, is it most to blame here, do you think?
I don't think so. They will, but the narrative will be to blame risk management of the banks. But think about this. Imagine you are the risk manager of one of these banks, and you hear over and over and over again in all of the FOMC meetings and the comments from the Federal Reserve and from economists close to the government, from the government itself, that inflation is because of the base effect, that inflation is because of transitory impacts, and that inflation is going to come back to 2% very, very rapidly, because all of those effects are for a very short period of time. Base effect, transitory, the so-called supply chain disruptions, the commodity cycle because of the Ukraine war, all of those messages basically were saying that inflation is something that you should not worry about because it's transitory. Okay, so if you're the risk manager and you're sitting in a portfolio of tens of billions of dollars of long duration sovereign bonds, what are you thinking? Well, I'm owning a very safe asset that is going to provide a stable value throughout periods of volatility, and therefore I don't need to hedge the duration risk, because the duration risk is very limited according to what everybody is saying about transitory inflation. So risk managers were actually only following the macroeconomic mainstream thinking that inflation had nothing, was nothing to really worry about, and with that central banks would not need to raise rates massively. Then central banks realized, one, that inflation was not transitory. Second, they realized that inflation was a huge monetary phenomenon and that they needed to hike rates and reduce the repurchases. And those sitting on those enormous portfolios of sovereign bonds found that what they were sitting is in an extremely expensive asset that was hugely overvalued to the reality of higher inflation and more stagnant growth, and that at the same time it did not provide the level of stability in the asset base that they expected. By the time that risk managers realized, it was too late and too expensive, because if you think about it, hedging duration risk at the moment in which everybody was saying that inflation was transitory may have been relatively manageable and relatively cost effective. But by the time that central banks started to hike rates and started to admit that inflation was really a monetary phenomenon and that they needed to take drastic and decisive action on inflation, by that time, hedging duration risk would have been phenomenally expensive and probably impossible to do. So, on the one hand, the investments in the risky part of the asset base moved and fell, and the investments in the safe, allegedly stable, allegedly low risk part of the asset base also fell.
And let me just pivot a little bit here. Goldman analysts expect no longer a Fed rate hike in March. What are your thoughts on that?
Oh, the Fed is probably going to make some adjustments to the rate hike path. And certainly the market has massively changed its position in terms of the rate hikes and the Fed funds rate for September because of this crisis. But I think it would be a mistake. I think it would be a mistake because if the Fed lets inflation run much higher for longer, the problem in the bond bubble is going to be much larger and uncontainable. So the Fed can make mistakes, and obviously banks can make mistakes. The situation that we are living right now with this few small banks and SVB is manageable and is certainly not something that may create a systemic risk short term. What can create a systemic risk is if the Fed pivots completely, goes back to provide the perverse incentive to continue to prolong and build accumulation of risk, and then when it bursts, it's unmanageable. Right now, the burst is relatively manageable. It's not easy. It's not going to be without pain, but it's relatively manageable. If the Fed decides to pivot and we go back to excessive risk building, then it's going to be much more difficult.
It's a very interesting discussion, and thank you very much for talking to me about it today.
Thank you so much. Thanks for having me.